Most investors think NIO is losing momentum. The stock has struggled through June, and many traders believe the EV rally is fading. But while Wall Street has been watching the share price, something extraordinary has been happening behind the scenes. New industry data suggests NIO has quietly captured nearly 100,000 firm, non-cancelable orders across its 3 brands in just 4 weeks. During the strongest week of that period, NIO reportedly generated more new orders than Li Auto, Xiaomi, and XPeng combined. And with the official June delivery report expected within days, investors are asking one question: is the market about to be caught completely off guard? Let's break down what's happening. The biggest story isn't the stock price. It's demand. Independent industry tracking networks indicate that NIO accumulated approximately 100,000 confirmed customer orders across the NIO, ONVO, and Firefly brands during the 4 weeks leading into mid-June. These aren't casual reservations or refundable sign-ups. These are reported firm orders that point to one thing: customers are still buying despite one of the most competitive EV markets China has ever seen. And that's what makes these numbers so surprising. According to the China Passenger Car Association, national retail passenger vehicle sales have fallen more than 22% year-over-year. The overall market is slowing, competition is becoming more aggressive, and many automakers are fighting simply to protect market share. Yet NIO appears to be moving in the opposite direction. Instead of losing momentum, the company is expanding its backlog while taking market share from some of its biggest rivals. But here's where the story becomes even more interesting. Those orders now set the stage for what could become NIO's strongest monthly delivery performance in company history. Management continues to guide for 43,000 to 48,000 vehicle deliveries in June. If NIO reaches the upper end of that range, it would represent another major jump from May's already record-breaking 37,705 deliveries. That would also push total second quarter deliveries into a projected range of 110,000 to 115,000 vehicles, an extraordinary result considering the broader slowdown affecting China's automotive industry. And the mix of vehicles matters just as much as the volume. NIO's premium ES9, priced above 500,000 RMB, has been seeing exceptionally strong customer demand. Higher-priced vehicles typically generate stronger profit margins, meaning investors won't just be watching delivery numbers. They'll also be watching whether this richer product mix improves vehicle gross margins beyond the 18.8% reported during the first quarter. In other words, it's not just about selling more vehicles, it's about selling the right vehicles. But while everyone waits for the delivery report, NIO has quietly launched another strategic move that could strengthen its premium position even further. Just days after the third-generation ES8 crossed 120,000 cumulative deliveries, the company officially introduced its brand-new 5-seat executive luxury variant into showrooms across China. At first glance, that may sound like another model launch, but it actually targets an entirely different customer. Many executive buyers want premium luxury without needing a third row of seats. By offering a dedicated 5-seat version, NIO expands its addressable market while continuing to reuse its existing vehicle platform. That means lower development costs, faster production, and potentially stronger profitability, all without building an entirely new vehicle from scratch. It's exactly the kind of efficiency investors have been hoping to see. Now combine all of these developments. Demand is accelerating while the broader market contracts. June deliveries are tracking toward another company record. Higher-margin premium vehicles continue gaining traction, and new product launches are expanding the customer base while keeping development costs under control. Yet despite all of that, NIO's share price has struggled throughout June. This disconnect between improving operational performance and market sentiment is exactly why the upcoming delivery report has become such an important catalyst. If NIO delivers somewhere near the upper end of its guidance, it would reinforce the argument that the company's operational momentum remains intact, despite short-term volatility in the stock. Of course, delivery numbers alone don't guarantee future share price performance. Investors will still be watching profitability, margins, and broader market conditions in the months ahead. But one thing is becoming increasingly difficult to ignore. While much of the EV industry is focused on surviving an increasingly difficult market, NIO appears to be executing a very different strategy, capturing demand, expanding its premium lineup, and positioning itself for what could become one of the strongest quarters in its history. Within the next few days, investors won't have to speculate anymore. The official June delivery numbers will finally reveal whether these remarkable industry reports translate into another record-breaking month for the company. And if they do, Wall Street may have to completely rethink its expectations for NIO heading into the second half of 2026. If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and turn on notifications, because we'll be covering the official delivery results the moment they are released.